Hey folks, are you ready for some cash flows? Um, you know, when I studied cash flows, I made mistakes every single time that I worked on it. And then when I started teaching it when I was in Texas, um, my mentor, Dr. Milton Jones, um, introduced me to the T account method. And I haven't made a mistake since then, and it is so easy to do. It may be intimidating at first, so just buckle down, pay attention, rewatch the video as many times as you need. I'm going to break it down into like three different videos. This first one is going to be a little piece of general information. The second one will be a T account method, and then the third one will be an introduction to the worksheet method. And the T accounts and making journal entries and the worksheet kind of all fit together. You really only have to do one or the other, though, not both. Okay, so general information for cash flows. What you're doing is you're going from an accrual basis balance sheet and income statement to a cash provided or used in the different areas of the company. So in your operating activities, investing activities, and in your financing activities. Mom and pop grocery store down the street don't care that we record revenue when we earn it and we record expenses when they're incurred. They care, where did my cash come from and where did my cash go to? So that's kind of the shortened version of the cash flow statement. Okay, so just kind of keep that in mind. So I have like a short list. It's not real short, but it's a little bit short list of the things you can expect to see in each area of the cash flow statement. And so if you'll notice, what I've done is I've broken down the balance sheet into current, like current liabilities, current assets, long-term assets, and then anything that has to do with debt and equity. Okay, because those are the primary categories on your balance sheet. Okay, so in your operating activities, since we're going from an accrual basis income statement, we're going to start with net income. And then we're going to add back any items that are on the income statement that did not require the use of cash or did not provide cash. So, depreciation expense, if you look at your journal entry to record depreciation expense, you debited depreciation expense and credited accumulated depreciation. There's no cash in that journal entry. So we add back depreciation expense, and then amortization and depletion expense all work the same way. Another item that you will add back is the loss on sale of assets. So we'll make I think we make a journal entry on this one to show how that works. So you add back losses and you subtract a gain, because the money you get when you sell an asset goes into the long-term investment, into the investing section, because it's a long-term asset that you're selling. So the gain or loss that hits the income statement needs to go up here in the operations area. Okay, and then you start dealing with your current assets and current liabilities. So what I learned was a source of cash is an increase in a current liability. And that's pretty much all I remember. And I use the acronym SIL, a source of cash is an increase in a liability. So I know if I increase liabilities, it's going to give me some cash. You borrowed money from the bank on a short-term basis. So that is a plus to cash. You add it to cash. So if you pay it back, if you decrease your current liabilities, you're going to lose cash or subtract the cash. And then if you recall, current liabilities have a normal credit balance and current assets have a normal debit balance. So since it's the opposite, then you're going to have the opposite effect. So when you decrease your current assets, like selling inventory, you've increased your cash. When you increase your current assets, like purchasing inventory, then you have decreased your cash. Okay, I know that's a lot, but if you can learn and write this down every single time you start an operating activity section, pretty soon it's going to be second nature and it's going to be really easy for you to compute that number. In the investing activities area, all we're going to take care of are our changes in long-term assets. And the primary changes are we sold some, which gives us cash, or we purchased some, which used our cash. It's pretty simple. Third area is financing activities. So think about how you finance your company. It's usually either with debt or with equity. So if it's equity, you sold some common stock to raise cash, or you paid dividends and that used cash. If you borrowed money from the bank, that gives you cash. If you repay that borrowed money, then it uses cash. It's not rocket science. It's fairly straightforward. You just have to translate the language in the problem to what you understand. Step 4, the fourth piece of the statement of cash flows, is a cash reconciliation area. And here, once you combine your answers for operating, investing, and financing, that will tell you whether your cash increased or decreased. And you will add to that the beginning cash balance, and that should give you your ending cash balance. So your check figure is however much your cash changed during the year. So you have an answer before you ever start with the cash flow statement, because your answer is the change in the cash from the beginning to the ending of the year. And the very last item that is shown on the cash flow statement is non-cash investing and financing activities. These are items, maybe you purchase land by borrowing money and you didn't have to put anything down on it. So no cash changed hands. So that would be an investing activity because you purchased land, and a financing activity because you borrowed the money to purchase the land. So it's non-cash investing and financing activities. All right, I guess there's one more thing I probably should have covered at the beginning, is there are two different ways to work a cash flow statement. One is called the direct method and one is called the indirect method. When you're doing the only difference is how you handle the operating activities. So these are operating activities for the indirect method. I should put that in there. And I am not going to cover the direct method at all. Okay? So that's the basic setup of the cash flow statement. Now I have kind of a step-by-step process to get everything you need. So you can obtain you can get your information together, and then I'll show you how to work a problem. So the very first thing you do is you obtain your data sources, and that's usually a set of comparative balance sheets. And as soon as you get them, you need to go ahead and calculate the changes in each account on the balance sheet, because what we're going to do is we're going to explain the change that happened in each account on the balance sheet. In addition to the balance sheets, you're going to need an income statement for the current year, and generally problems are going to give you some additional information. Sometimes in the easier problems they will not give you the income statement, and they'll just give you the information you need off of it in the additional information. So don't stress if you don't have the income statement. Alright, the second thing you're going to do is calculate your check figure. So you have your answer before you ever start. And that's the dollar amount of change in the cash account. So what did it do from the beginning balance sheet to the ending balance sheet? That's your answer and your check figure. Okay, we're going to be working the T account method. So what you need to do is you need to set up a T account for every account that is on the comparative balance sheets. And what you're going to do is you're going to show the change in each account as a debit or a credit as needed, because we're going to try to explain the change in the account and not every transaction in it. For example, if accounts receivable increased by $10 during the year, then we're going to show a debit of $10 in the accounts receivable T account on the debit side. And we're just going to simply explain why accounts receivable went up $10. And you do that for every account on the balance sheet. Okay, step 4, we're going to recreate journal entries from our additional information and from information on our income statement. So I'm going to post the cash that happened in the journal entry. So, okay, let's go back to this for a second. These journal entries are kind of worksheet entries only. They are only to help you work the cash flow statement. They are never put into the set of books because everything that we're recreating has already happened and we don't want to double count it. So these are just like on the side, on a piece of paper, nothing to be entered formally in the accounting records. There should be cash to most every journal entry that you're going to make. So the cash is going to hit the cash T account, either in operating, investing, or financing section. The other pieces to the journal entries will hit the other debits and credits for the accounts in each account on that comparative balance sheet. That may sound confusing right now, but I hope you get it once I show you how it's done. Okay, after that, you want to confirm that you have every change made for your long-term asset accounts. Confirm that every change is made in the long-term liability accounts, and confirm that all the changes have been made in the stockholders' equity accounts. So the only thing that you haven't checked and probably is not done yet are the changes in current asset and current liability accounts. So what you're going to do with those is you're going to make and post the journal entry that accounts for the change in those current accounts. So we'll go back to our accounts receivable. If our accounts receivable increased by 10, we're going to debit accounts receivable for 10 and credit cash for 10. So whatever you need in the current account will be what you put there, whether it's a debit or credit. And then the opposite piece of the journal entry will be the cash account for the same amount. If you credit cash, that is an outflow on the cash in the cash piece up in the operating section. If you ended up debiting cash, that's an inflow of cash. Okay, don't lose hope yet. Come back for more, and I've set up a problem and we're going to go over that problem. Okay, I'll see you in just a minute. Bye.